Today's webinar is co-hosted by SecureDoc's Virtual Data Room and TechStrat, and presented by TechStrat founder Nat Burgess. Before we jump into things, I'd like to tell you a little bit about SecureDocs and introduce our presenter. First, let me tell you about SecureDocs. Headquartered in Santa Barbara, California, SecureDocs Incorporated was founded by the team of engineers that created and launched GoToMyPC, GoToWebinar, AppFolio, and RightScale. SecureDocs offers an affordable, easy-to-use virtual data room solution for securely storing and sharing corporate documentation. Our solution is used for audits, business valuations, fundraising, M&A, licensing deals, strategic partnerships, legal events, and more. When specific events aren't taking place, the data room is used as an extremely secure document storage solution for finance, human resources, legal, and other critical documents of record. Our customers are extremely happy with our solution because of its ease of use and the money they're saving with our flat-free pricing of $250 a month for unlimited use and maximum security. But last but not least, we enjoy hosting free educational events for professionals in the industries we serve, and that is why we are all here today. Next, I'd like to tell you about TechStrat. TechStrat transforms lives and organizations. Their clients are builders, smart people who have created value for themselves, their employees, and their partners. They work with their clients to open new chapters in their lives and to create more opportunities for the people who rely on them. They are an M&A and strategic advisory firm, but in their world, transactions are a means to an end, not an end to the story. Their goal is for every client to look back on their achievements together and to say, I'm glad I did that. For their clients to look back with pride on their transaction, there has to be success for the buyer or the investor as well. Some of their clients have stayed with acquiring companies for 10 or more years. Others have departed shortly after closing, but never as a surprise to the buyer. They've worked with financial sponsors to help create meaningful growth platforms in payroll processing, financial reporting, supply chain, and other vertical markets. They pride themselves on building new connections, bridges between geographies, markets, and companies, and to bringing a variety of options to their clients so that they can make decisions in context. They know the software industry well, and after 20 years and over 100 transactions, they count many of their deal makers in the industry as personal friends. TechStrat recently completed a transaction in biotech and look forward to expanding their activities into the life sciences. They have experience in most of the vertical markets and have closed horizontal transactions with Google, Microsoft, Intel, and others. Finally, it's my pleasure to introduce our presenter, Nat Burgess. Nat Burgess, TechStrat founder, has been an M&A advisor since 1989, an angel investor and startup mentor since 1994, and a lawyer since 1998. Prior to being appointed chairman of the World Financial Symposium and president of Quorum, he worked for Morgan Stanley's M&A group, helped Activision put the first generation of multiplayer games on the internet, and interned with the enforcement division of the SEC. As an M&A advisor, Nat has managed transactions with Microsoft, Google, Intel, Symantec, and many other leading companies across the US, Europe, the Nordics, Asia, and Latin America. He has also raised capital from Vista Equity Partners, Intel Capital, Carlyle Group, Marlin Equity, and many other leading private equity firms. He is a sell-side specialist with a 20-year focus on technology. His tombstones include the sale of Ghost to Symantec, the sale of Olaworks to Intel, the sale of Instantatious to Google, the sale of Caligari to Microsoft, the sale of Atago to PTC, and the sale of Estral Technologies to Ansys. As an angel investor, Nat was a founding investor in Sequent, participated in 2 follow-on rounds, and organized additional funding from Japanese investors. Sequent was sold in 2009 to TNS for $112 million. Nat also assisted 2 startups that sold to Google, FatBits and Picnic, and was an angel investor and advisory board member for SiteScout, sold to an investor group. As an advisory board member, he has helped Has Offers raise a Series A round from ASSEL. Nat is a frequent guest on CNBC and a nationally recognized speaker at industry conferences such as the World Financial Symposium and the RSA Security Conference, amongst others. In addition to his professional activities, he and his wife founded the Lopez Strings Workshop for promising young musicians and actively support their children's schools. Nat holds a Bachelor's of Arts degree in Japanese literature from Yale College and a JD from the UCLA School of Law. He attended Kansai Gaidai University and ICU in Japan and has lived and worked in Tokyo, New York, and Paris. He is currently based in Seattle. Nat, thank you for being here today. I'll now hand things over to you.
Thank you, Tara. I really appreciate the kind introduction and the opportunity to spend some time with you today and with our participants. As you heard in my introduction, I've spent most of my career as an advisor, but I have also sat on boards and I've been on the other side of the table when companies are considering hiring an M&A advisor or investment bank to manage a process. And that will be our laser focus today. I hope we were clear in our description of this event that really we're trying to add value to management teams, boards of directors, and shareholders who are faced with the process of choosing an advisor. And we look forward to walking through our best practices today, primarily, again, from the standpoint of sitting on the board side of the table and working hard to make the best possible choice. So for most companies that are faced with this decision, there have been years spent building value in a business. Years of hard work, hiring, firing, making payroll, late nights. And at the point where it's time to sit down with bankers and advisors, you will be marketed to by very smart people, and they will work very hard to put together presentations that show their strengths. And when you make that decision to work with a banker or advisor, it's similar to choosing a roommate in college or to making a C-level executive hire in your company. You're gonna live with that decision for a long time. That's just the way this process works. There are very good reasons for why these relationships are structured the way that they are structured, but it means that we have to be sure that we're making the right choice. And a little hyperbole here, but if the process is horribly mismanaged and there's self-dealing, conflicts on the part of the board, guess what? Personal legal liability. The other critical point here is that in this decision, you're balancing competing interests of multiple constituents. The best choice for your board may not be the best choice for the shareholders or for management. We'll talk about how to work your way through that. And then finally, in most of these scenarios, you're under pressure to make the right decision fast. And the best decisions are seldom made fast. But if you've been approached and you now want to make sure you calibrate the market while professionally managing the inbound interest, then you're going to need someone on your side quickly, and that drives the decision. Or if there's been a long-standing debate and then suddenly everyone's aligned around, let's go make this happen, let's go make a deal happen, again, there's pressure to move quickly because you want to take advantage of that moment of alignment and get everyone moving in the same direction. So in almost every case, there's time pressure. So our goal in the next hour is to give you the tools that you'll need to hire the best firm for the job. Selling your company takes a process. Hiring the right firm to manage the sale also takes a process. This is not a sort of window shopping exercise where you pick the best one. It's a process, and we'll talk about how you do it. There are a lot of people who will want the job. You're going to, depending on the size of your firm and the nature of the transaction, you'll have Gordon Gekko visiting from Wall Street. You'll have the sort of high volume brokerage firms. Hey, you want to buy a watch? Rolling back their sleeve and offering companies for sale. You'll have the overworked boiler rooms that are trying to keep up with the volume that they've taken on, but struggling and just trying to buy time and make a few calls. And you'll have the sort of the sincere, convincing sign here, we'll take care of everything pitches. So you're going to have a lot of skilled sales efforts directed at your board, at your management team, at your shareholders. And your job is to sift through that, figure out what's real, establish guidelines and a basis for making a pragmatic, successful decision, and not be swayed by the allure of the shiny object. So just a quick a summary on our perspective. We work with privately held tech companies. We're targeting deals between 10 and 100 to 150 million. Frequently, we're running parallel processes where we're talking to strategic buyers and financial sponsors. We do not get involved in IPO, debt, early stage capital raise. And so we wouldn't be pitching for that kind of deal, but we very well might be on the other side of the table as board members or advisors. And so I think the guidelines outlined here are fairly universally applicable, even outside our advisory context, in terms of selection criteria, building relationships, checking references, the decision to engage, the questions to ask, and the specific considerations for the board of directors. So what we're going to cover in brief, figuring out the right category of advisor for your situation, anticipating some of the twists and turns to closing, managing the different goals of management, board, shareholders, establishing the selection criteria, building a relationship with your advisors, and really testing them against a set of specific measures that we'll talk about. We're also going to cover the regulatory environment and look at whether broker-dealer registration is required on the part of your advisor, as well as look at the board liability associated with retaining an advisor. We'll talk about the final decision, whether you run a bake-off, interview multiple parties, or make a preemptive choice. If you choose to do a bake-off, we'll describe how you do that and make it successful and effective. Questions to ask the candidates. We'll look at some of the reasons why deals and processes sometimes go off the rails. And then at the end, we're going to offer up a resource, which is our 2-page cheat sheet that basically summarizes everything we're covering today that you should keep in your sort of back pocket, because at some point you'll be able to pull it out, organize the board, organize management, run an effective process to select an advisor, and create a successful outcome for your company. We'll pause here for a quick polling question. Tara?
Okay, we're going to get started with our first polling question today. What is the most important role of the advisor? To shield directors from liability, to maximize the value to shareholders, support management, or all of the above? Okay, it looks like 68% of you have voted. Those of you that have not responded yet, go ahead and submit your responses now. We will close the poll in a few moments. Okay, we are now closing the poll, and I'm going to share the results. Okay, what is the most important role of the advisor? To shield directors from liability, we had 0%. To maximize the value to shareholders, 17%. Support management, 0%, and all of the above, 83%.
Thank you, Tara. That was a bit of a softball question, but I'm really pleased to hear the responses, because that aligns nicely with our view on this. We'll talk specifically about how the advisor can shield directors from liability. We'll talk about how the advisor can maximize value, and then the critical but often overlooked point, how the advisor can offload a lot of the work in a process from management and provide support and make sure that they get to continue running the business. So with over 80% response on all of the above, we're very well aligned as we go into the next part of the presentation. So let's start with horses for courses. You want to go public, you're a high-flying, high-growth unicorn, you need Goldman Sachs, Morgan Stanley. They can go and put the deal together for you. Or if you're doing a $500 million raise from the Saudis, you need the bulge bracket firm. If you're raising some mezzanine debt or Series C, and it's really more of a capital issue and maybe IPO, there are a lot of really good mid-market full-service firms like Barclays or JMP that can manage that process for you. If you're looking at either M&A or a recap growth equity, and you're in a specialized niche, we advocate hiring a specialist boutique. That's because partly that's what we are. And that's where we live, is in technology, helping firms achieve those goals. But we see advantages there to having someone who really understands the landscape and is laser focused on solving exactly the kind of problem that you need solved. And then if you're a smaller business, sort of generalized business, then a more general business broker will do the trick. And if you're just looking to fill some gaps and get some help from an experienced person, a consultant, a retired executive, someone you can bring in to just provide some guidance, may be exactly what you need. And here's another way of looking at the same set of problems: objective versus IPO category, or versus advisor category down through the list. And the only thing I'll call out here is that if your goal is to merge your business with a publicly traded shell company, don't hire an advisor. Go rethink your strategy. We would encourage you not to go in that direction. I'll keep moving in the interest of time. We have a lot of ground to cover. It's important to note that a lot of these processes start down a path and then finish at a different destination. It's common to file an S1 and do all the work to go public and then be acquired by a strategic. The S1 kind of forces the issue. To execute that strategy, you need a firm that can do both. So you need the IPO firm. It's very common to go after a capital raise and be acquired, because the strategic acquirers see that happening and say, oh, we better act now. We're going to lose this opportunity. They're going to get a lot more expensive. It's also common to go after a strategic M&A deal and end up with a private equity recap. So the point here is, make sure that you're picking an advisor who's appropriate, not just for your aspirations, but also who will be very effective in managing the likely different outcomes of the process. Now, as you head down this path of talking to firms, the board of directors will have their own set of agenda items. They need to maximize value to the shareholders. That's their job in terms of governance. They have fiduciary duties to the company. They need to avoid conflicts. They need to avoid self-dealing. And so hiring an outside advisor actually helps create that sort of third-party objective perspective on the process and shields them from liability. Boards are busy, and their job is to govern, not to manage. So they want to make sure they don't have to jump in and manage the process. And that means hiring a firm that's going to be effective and is going to take care of it. And then the board also needs to avoid being overly influenced by favors owed or by other sort of interests outside of the interests of the company. Management has a different set of priorities. They need a collaborator and a partner who can stay with them through the process and support them. They need a group that'll get things done and not just assign all the tasks back to the management team. They need a firm that's going to be respectful of management's time and not bury them in unnecessary work, but use their time efficiently. And obviously, they also are interested in maximizing value to the shareholders, which means choosing an effective, successful firm. And then for the shareholders, it's a lot simpler. They want to maximize value, and they want a deal structure that presents minimum contingencies or ongoing risk. So these are the interests that have to be balanced. And the good news is none of these are mutually exclusive. They're all complementary, but they all need to be weighed in choosing an advisor. So Tara, let's quickly put up our polling question number 2.
Okay, our next polling question is, who is ultimately responsible for selecting an advisor? Management, board of directors, or shareholders? Okay, it looks like about 75% of you have responded. Those of you who have not yet responded, go ahead and submit your responses now, and we will close the poll in a few moments. Okay, we are now closing the poll, and I'm going to share the results. Okay, who is ultimately responsible for selecting an advisor? Management, 21%, board of directors, 73%, and shareholders, 6%.
Interesting. And Tara, thank you. I'm going to guess that the capital structure and governance of the companies that answered in each category are quite different. Because for a privately held firm that is owned by the founders, the board is a little bit abstract, and the managers are also the shareholders, and these things all, these decisions are all sort of intermingled. But overall, I think that ultimately it is the board, and there's no case law that says the board must select the M&A advisor. However, in its governance role, the board actually controls a decision to sell the company. So the board will make a recommendation to the shareholders to accept an offer and to do a deal. And in making that recommendation, they have potential liability for not meeting what is called the Revlon standard, because there is a famous case involving Revlon that established this duty of care that boards have to the shareholders. And the board does have some protection by what's called the business judgment rule, which is just a presumption that they're going to make decisions based on their business judgment in the interests of the shareholders. But ultimately, they will be the one recommending a deal. And so it's in the board's interest to retain an advisor, to have expert independent advice that informs that recommendation, and ultimately a basis for making that recommendation that is not just because they think it's a good idea, but more because they hired a qualified advisor to go out and serve the interests of the shareholders. There was a thorough process, all options were looked at, and out of all those options, the board is recommending that the shareholders accept the best one. So again, there's no explicit case law that says board must make selection, but given the duty of care and the standards that boards are operating against, it really is the board's decision to select or recommend selection of the advisor. I'm going to call out a couple of things here for smaller companies that are emerging, that don't have mature governance. There are concepts at work here that are very effective even in very small companies with maybe only 2 shareholders. And those concepts are, if you're in a board meeting, wear your board hat and really focus on considering decisions from the standpoint of the board and from the standpoint of the duty of care of the board, number one. And then number 2, for big companies going through a process like this, they typically, you want to avoid having the board micromanage the process. The board should be monitoring the process. And so typically they will appoint an M&A committee that oversees the process, provides governance, but doesn't try to do it. And so when I sit down in a meeting and 4 board members are all saying, hey, I know Joe over at Microsoft and I know Jack over at Symantec, try to take a step back and say, hey guys, we're hiring a firm to take care of this, and we'll appoint an M&A committee and we'll check in with the advisors regularly and monitor, but we're not going to try to do it ourselves, because the board's job is governance, not to manage. Okay, so the board has decided to select an advisor, or the board is anticipating that the company should. How do we break the ice? How do we start the dialogue with outside firms? I think it's really useful to call on advisors and to ask them strategy questions. Hey, Mr. M&A advisor, hey, Mr. investment banker, should we prioritize growth or profitability? Which is going to build more value in our company? What are the implications of some of the recent acquisitions in our market segment? Are we comfortable being a premise software company that's very profitable, or do we need to pivot to SaaS and burn the boat on the beach? As a firm, who should we think about hiring? Who is our most critical next hire to build value? Market timing. What triggers should we look at for the decision to go to market? If we're not audited, should we? If we have a year end in June, should we change it to December? Do we need to change our corporate structure from an S to a C? These are the types of questions where you can have a dialogue with an advisor. You start to get a sense of how familiar they are with your market and how well you can work with them in an advisory capacity. And ideally, if you have time and you're not in a compressed decision mode over a period of months, you figure out who you want to work with. And then the decision kind of makes itself. Obviously, we need to be respectful of everyone's time. So as a courtesy, you can let them know that you're aware that their time is valuable, and try to set a cadence of conversations that will be useful, but not burdensome. This is how the best advisory relationships are formed, in my opinion. And so even if there's no plan on launching a process for 12, 18, 24 months, it doesn't hurt to start the dialogue, to figure out who you're comfortable with. And if the response is the hard sell, go now, the market's hot, you're going to lose your opportunity, you can be pretty confident that's not the firm for you. But if there's real data there, there's a roll-up underway, there's a data-driven conversation that says do something earlier, yeah, probably good to listen. This is a chance for you to get access to a lot of insight in the market that you may not otherwise have access to. Now it's time to make a decision. Who are you going to work with? We look at a couple of critical factors. The first is experience in your market. If you are a CRM company, has this firm done anything in CRM? Do they know the buyers? If you're a business that's going to sell for $40 million, have they only done deals over 200 million or under 10? Or do they have experience in your enterprise value range? If your business is most likely to be acquired by a company in China or an investor in China, do they have contacts there in the geo where your candidates are? Do they know your buyers? Do they have experience working with companies that are at your stage of growth? And then even more critical, who is the person that you're going to be working with? Are they a natural deal maker? Can they negotiate? Can they sell? Can they get people interested in your story? We have this, one of my clients used to call it, are they tuned in to WIIFM? And for those of you who are younger than me, FM is a radio that we used to listen to before the internet. But this is what's in it for me. It's the hallmark of a deal maker. They're listening, they're absorbing, and hopefully they're listening to you and absorbing and figuring out how to work with you. Are they familiar with the legal, financial, and strategic nuances of deal making? Do they have personal experience in your market, relationships with buyers? Are they a leader? Can they be a CEO of the process? In other words, can they sit down with the board and the CEO and the biggest shareholders and be a leader, provide objective advice, and move the process forward? This is important because, as with any service industry, there's always the opportunity for the bait and switch. You get high quality time with a senior experienced deal maker, and then the day after the engagement letter is signed, they roll in the freshly minted MBA to help you run your process, and you never see the senior person again. So make sure you're paying special attention to who's actually going to lead your account. Now, it's critical that your advisors can engage and sell, and guess what? This is the perfect opportunity to watch them at work, because their job now is to be persuasive, compelling, and accurate in their interactions with you. And you can judge, how do I feel about that conversation we just had? Does it feel right? Do I believe them? Do I have lingering doubts? Are they persistent? Is there a cadence of interaction that sort of keeps them top of mind as they try to win the mandate, but that isn't excessive? Is their approach academic? In other words, did they learn the script of, this is how an M&A process works, I'm going to read it to you, and now you'll think I can manage your process? Or is it active? They're learning, they're understanding your specific situation, and they're writing the script. They're figuring out exactly how to tailor their knowledge and the market dynamics to your best interests. How effective is their process? Now, I'm not sure how we ended up with a laptop in a car wash, but if I want to wash my laptop or clean my laptop, if I need to clean my hard drive, I'm not going to send it through the car wash. So I need to make sure in this context that I'm being pitched a process that is going to satisfy our needs. It's going to get done what we need to get done. So ways to judge how effective their process will be: listen carefully to how they position you. Do they understand your business? And do they know how to position you with potential buyers? Are they able to create a crisp and compelling and data-driven SIM, or confidential information memorandum? And I will tell you that it's a lot easier to write an information memorandum that appeals to the client than it is to write one that captures the attention of buyers. The client likes to hear about how they're the world's leading expert in whatever market they're in. Buyers need the facts. They need data. They need grounds for decision. Every assertion needs to be backed by analysis. And so that's the approach that works. Are they able to align the board, shareholders, management on steps? Do they have appropriate contacts in industry? Are they able to create a thoughtful and appropriate candidate list? Are they presenting a realistic schedule, or just sort of promising whatever they think you want to hear? Can they manage the creation and administration of the data room, ideally in secure docs? And are they going to help you with rehearsals? Get management trained up on how to pitch the company, which is very different from pitching the product. And so, interesting what happens in, we use Google Docs, and when it gets translated down to Outlook, we tend to drop letters. So these aren't typos, these are dangling N's and H's. But this is how we think about process: preparation, research, outreach, negotiation, diligence, close. And these are the steps along the way. These slides will be available, I believe, in the archive. So if you want reference, then this is useful. But if I were to say, what are the highest value items on this list in terms of what the advisor is going to do for you, it's really building out the management presentation, advising you on the data room so that you're crisp and prepared, and building out the financial model so it doesn't leave questions lingering, so it answers questions and it really puts your best foot forward. The research on appropriate contacts, and then being able to manage through the M&A process through closing. How good is their network? LinkedIn is the great equalizer, right? I can go on LinkedIn and I can figure out who does M&A at every company. Problem solved. But not really. There is no substitute for having an active, engaged dialogue and interaction with a broad network of individuals. And the reasons are, there are multiple reasons. One is we're seeing 20 to 30% turnover in the M&A function at LinkedIn every year. But maybe more importantly, the advertised corporate development function at a lot of the big buyers is, in fact, what we call a honeypot. And that's a term that comes from the security industry, where someone will put what looks like a data set of high value out on the open web to attract hackers. And then they get to test security measures because they're drawing a lot of attention from hackers as they try to get access to this data store. And for a lot of the buyers out there, the corp dev function is very similar. So you'll have someone who's advertised as the director of corporate development, and they get inbound inquiries all day long. Maybe they get 25 a week. And maybe they kind of circulate them around, but typically their job is more to execute on deals that are initiated by product groups. Their job is not to originate deals. And so relying on LinkedIn and just going out to the individuals who pop up at the top of the search there doesn't actually get deals done. The deal makers are hiding. They're busy. they're scanning the marketplace. They're getting to know companies. They're in product groups or divisions. They're in operating groups, and they're trying to prioritize their own time. They don't have time to look at 25 inbound solicitations a week. They need to pick the one that they think might make sense and focus on it. And so the network is critically important, and this importance is not really undermined by the growth of LinkedIn. Real relationships really do matter. And then the other point is endurance. We all like the stories in the Wall Street Journal about how the two CEOs played golf on Sunday and then they closed the deal on Monday. But in the real world, it's 6 to 12 months to close a deal. You might be 3 months in diligence, depending on the complexity. And for an advisor that's working on multiple projects for a firm that has dozens of clients, it's pretty important. You're one of many clients for them, but this is the only deal that matters to you. And so you need to make sure that they have the endurance to stay with you as long as it takes and to stay engaged. So I'm going to stop there on the selection criteria, but hopefully that gives you a sense of what, when I'm on the board's side of the table, what I'm examining and looking into, because I just want to make sure that the firm has experience in our market, in our stage of growth, at our deal size, that they're deal makers, the people that are representing us are deal makers, and that I know exactly who's going to be running the engagement, and I'm convinced that they're going to stay with it through the end. Those are soft sciences, but they're important, and we'll get into specific questions that uncover some of those things shortly. Now let's take a brief tangent into broker-dealer land. Is broker-dealer registration required for an M&A firm? No, currently, unless the client is a publicly traded company, the client is a big private company with EBITDA or revenue over 250 million, or we're in a scenario where there's custodial duties over funds, or I would say also a group deal where you're doing a fundraising effort and you're going out to multiple investors. That broker dealer is also required for that. The rules have changed over time. There was a sort of a piece of case law that in 1985 that shook everyone up, and basically that even a person who makes a couple of calls on your behalf from their own Rolodex needs to be registered as a broker dealer if those calls help trigger a deal and they get a fee. So everyone scrambled to get broker dealer licenses after that, and then in 2014 there was an SEC no action letter stating that a broker-dealer registration was not required for intermediaries in a stock deal unless taking custody of funds, providing financing, organizing a group of buyers. And then at 2017, the Jobs Act, there's a broad exemption from registration. So I think broker-dealer registration is sometimes seen as a sort of a stamp of approval, like there's been some scrutiny on the business and they're in compliance and their people have all passed the test. But the truth of the matter is that for the firms that have the broker-dealer registration, when they're doing a simple asset deal or simple M&A deal, they're often not even running the deal through their broker-dealer registration, because why pay fees on it when it's not required? And the broker-dealer, sort of the tests and the compliance criteria are actually not relevant to the M&A work and the sort of recapitalization work. So this is an area where there's some confusion and there's a fair amount of literature online, but this is our position. All right, you've created your short list of advisors. You're comfortable with how your short list firms built the relationship with you over time. You're impressed with their deal experience, comfortable with the person who's going to lead the charge, and you're confident that they have the endurance. What do you do now? Well, there are a couple of avenues here. And again, I apologize for the reformatting that happens when we go from Sheets to PowerPoint. but it's legible. You've got two avenues here. One is recommend and make a choice. The other is run a bake-off. The advantages of just making a choice: high confidentiality. You're not sharing your information with multiple advisors. Mutual commitment. You're basically going to someone and you're saying, we're going to make a decision now, and we're foregoing other options, and we're taking risk. We need you to make an equal level of commitment to us. Puts you on a flexible timeline. You don't have 3 or 4 bankers calling you every day saying, hey, what else do you need from us? Have you made a decision yet? You could actually go into more of a high-level advisory mode and pull the trigger in 6 months. The downside of preemptive selection is limited calibration of options. So you haven't gotten that insight and data from 3 or 4 firms. So you're losing the benefit of access to the intelligence that would be provided in multiple presentations. There's the risk of a kind of a runaway train where the process takes on a life of its own, and you really have lost control of it. In a bake-off, you get access to multiple perspectives. You can do head-to-head comparisons between people and process and preparation. Sometimes it's easier to create alignment among management, board, and shareholders through the bake-off process, because it's a lot easier to decide which cheese you like when you've got 3 selections at the supermarket end cap, and you don't have to just sort of judge one on its own. It can be time consuming though on the negative side. You can burn a lot of board time, a lot of cycles running this process. You're going to engage in broad disclosure, and you end up in a very formal setting with scripted presentations that don't always tell you how these firms will operate after the first punch is thrown. Every situation is different, but these are things to think about, pluses and minuses. If you decide to do the bake-off, here are some guidelines for how to make it a successful bake-off. Limit to 2 or 3 advisors. Don't try to go boil the ocean and talk to 10. Check references. My bias is that if an advisor puts a tombstone up on their website, you could call that CEO and ask them how their experience was working with that advisor. And this is a little bit of a controversial opinion, because generally these references are closely guarded, and people take a lot of care in selecting and making sure that you're talking to exactly who they want you to talk to, which is fine. It can be more efficient to get to someone. But when I'm on the other side of the table in the board seat, I don't hesitate to just pick up the phone and call a CEO and say, what was your experience like working with X? You're going to learn a lot more that way. And if you end up with a negative review, take the time to make another call. Don't stop there, but check references. Limit the presentations to a 90-minute window, maybe 60. Provide the same agenda to everyone so you can make comparisons. Provide guidelines and questions to the participants on your side of the table, not just to the bankers, but to your side of the table, so that everyone is participating in the discussion. And then understand and balance the agendas of management, board, shareholders. And here again, I'll put this slide up one more time as a reminder that everyone has their own view, and they can be highly complementary, but they all need to be heard in the bake-off. What should you learn from the bake-off? You should learn about the firm. You should learn how they will position you. You should hear their opinion on who should buy you and why, what kind of valuation range they anticipate, and who will lead the transaction on their side. Along with the bake-off, there's the pitch book. What do we learn from the pitch book? Well, if it's boilerplate, high-level, generic comments on how M&A works, you can be pretty confident that the firm will deliver generic, high-level, undifferentiated messaging to your buyers. And it could be because they're just too busy to prepare, but that alone is grounds for disqualification. If the pitch book has new insights on how to position your company, new ideas, research on specific buyers, detailed valuations, this firm is going to present you thoughtfully and impactfully to buyers. So you learn a lot just in the approach. How much time did they put into it? And did they bring something new to the table? And now we have the questions to ask. We're going to go through these quickly, but I would seed these questions out to your CEO, to your other board members, and everyone should have a voice in this. And these are just good guidelines for the discussion. So, Mr. M&A firm, investment banker, has your firm ever sued or threatened to sue a client for a fee? What portion of revenues come from sell side, if that's what we're doing, or capital raise, if that's what we're doing? What percentage of your efforts go into marketing your own services versus marketing your clients? How do you manage conflicts between buy side and sell side? What is your unique differentiator that'll give us an advantage? Are you aware of any roll-ups going on in our segment among the private equity firms? Tell us about your most recent cross-border deal. What percentage of sell-side engagements sell within 12 months of engagement? Give us an example of a successful deal and how your unique approach made success possible. And conversely, tell us about a failure. What's the valuation and how do you support it? Describe your process and plan and timeline. How do you manage confidentiality? How do you propose contacting direct competitors without undermining our business? What is the market currently for companies like ours? What are the trends driving deals? What are the transactions that are relevant to us? And how are buyers determining valuation? What's your outlook for M&A over the next 2 years? Should we be in a hurry? Is the market going to improve or get worse? How will you make us relevant to buyers? And then on market terms, these are your clues to the puzzle on, are these guys actually in deal flow and aware of what's going on in terms of current market terms? So what level of personal indemnifications are being requested of CEOs in today's market? Are buyers demanding escrows or holdbacks? Which? How long? What percent? Are buyers paying cash or stock? Is there a difference in the valuation they'll pay? What about a difference in valuation between asset and stock purchase? What's the likely deal structure for our firm? Should we anticipate structure, earnouts, holdbacks, et cetera? And then on the deal team, who's going to lead the engagement? What have they done recently in similar circumstances to ours? Have you done buy-side work for any of the potential buyers of our company? What else will the team be doing while they're working with us? Do they have 10 other deals in flight? What percentage of their time will be dedicated to us? Which companies do you predict will be the top 5 bidders for our firm? Who's going to draft the confidential information memorandum? Is that back on us with some oversight, or is there going to be work done on the advisor side? Who do they need access to do that? What virtual data room do you use? And if it isn't SecureDocs, well, anyway. I've actually worked on over a dozen deals now where we managed the due diligence process through SecureDocs. And I love the pedigree of the developers who built the platform, the GoToMeeting. I mean, these are modern SaaS operating at scale, secure, high quality platform, and not priced like it's 1990, priced appropriately to the market. So I can wholeheartedly endorse SecureDocs. How frequently do you provide updates to your clients? And what's going to be the time commitment of the CEO? Finally, compensation. Explain your fee structure. Do you have minimums? What's the tail period? Do you render a fairness opinion? If so, what's it going to cost us? If not, how do we do that? All right, let's pause here for polling question number 3, Tara.
Okay, this is our final polling question. And it is, what percentage of deals fall apart between the letter of intent and closing? 10%, 40%, or 80%? Okay, it looks like 70% of you have responded. Those of you who have not yet responded, go ahead and submit your responses now, and we will close the poll in a few minutes. Okay, we will now be closing the poll, and I'll share the results. Okay, what percentage of deals fall apart between the letter of intent and closing? 10%, had 21%, 40%, 48%, 80%, 31%.
Thank you, Tara. So the truth is, nobody knows, because a lot of these deals die in the shadows. But as an observer of the M&A markets for 20 plus years, I think it's close to 80%. And it doesn't have to be. So everything we just talked about in terms of how you pick an advisor is also answering the question, how do you run a successful process? I talked about how you align shareholders, management, and the board. I talked about how you seek outside advice on what is the likely valuation, who are the likely buyers. I talked about a proper process where you're building out the story properly, you're crisp in due diligence. These are all the steps that result in a 10% failure rather than an 80% failure. But I think 80% is the norm in the market. And so that's why this topic is so critically important, because how you prepare and manage and who you hire and how you work with them really determines whether you're part of that 80% failure rate or whether you get to the finish line with a successful transaction. So, okay, some closing thoughts. We're going to have a little bit of time for questions. So I would encourage you to be asking questions as we reach the finish line here. If you run a bake-off and you're going to choose one firm and tell two firms that it's not their mandate, we don't recommend telling them that you've decided not to run a process, because A, it's not true, and B, they'll find out. So I've seen that game played before, and it just doesn't make sense. Instead, basically be respectful. Thanks for your hard work, your insights. Based on their selection criteria, our board has retained another advisor. Now, or based on recent deal activity and recent experience in our sector, our board has retained another advisor. But be respectful, because we're all talking to each other out there, all the bankers. It's a nonstop network. And if you've left everyone feeling positive about your company and feeling like there's a good process to select a banker and a good process underway, that's going to help you later, because one banker is going to call another and say, hey, you know what? We've got a buyer who's looking for this, and we think maybe you guys won the mandate, right? That's the reality. So be conscientious in how you close out the bake-off. So just some closing thoughts then. Alignment, talking to advisors, figuring out who you want to work with can help create alignment around milestones, responsibilities. You want to have clear, impactful positioning and work with an advisor who can help you do that. Regular comprehensive communications and a pragmatic, open-minded assessment of market feedback and aggressive course correction when necessary. Things may not unfold as you had planned, but they will unfold and you will learn a lot. And so being open-minded and course correcting as necessary is critical. Things end badly when the advisor overpromises or gets the board excited about a valuation that's just simply not achievable. M&A is really tough when you're out of money, when it's really a lifeline, not an accelerator. So you want to be pursuing this when you've got a bigger growth opportunity than you have resources to meet. Things end badly when management isn't properly prepared for presentations and they go in and start pitching their product rather than their company. And things go badly when the advisor is simply rebroadcasting what's on your website. There needs to be new insight, because everyone knows you're there already. The question is, what's the trigger that's going to suddenly make you look attractive from an M&A standpoint? That's the end of our slides. And I think we do have a few minutes. I went a little bit over, but I think we have a few minutes left. We have 5 minutes before the hour. So Tara, do we have any questions?
Sure. So thank you, Nat. And just a reminder, you can still submit text questions through the question pane in the attendee control panel. Okay, so here's one for you. Can a director be liable for a bad outcome in a situation where they did not participate in selecting an advisor or they chose poorly?
Interesting. So this would be a scenario where a director just sits out the decision on who to hire, lets the process unfold, and then there's kind of a nightmare outcome. And I think obviously it depends on the circumstances, but I think the answer is yes, they can be liable. Because as we discussed earlier, the director has a clear duty of care to serve the best interests of the shareholders. And they are clearly in the decision seat in terms of the decision to sell or recommendation to sell the company. And so if they failed to take steps that really reflect that due care and kind of didn't fulfill their duties, then yes, there is potential director liability.
Okay, and the next question is, what is the typical fee structure for M&A advisors?
Good question. So when I was at Morgan Stanley, I think we would average down to 1.5 or 2% on an M&A deal. And this was a long time ago, and our minimum deal size was about, I think it was 250 million at the time. So the fact is that the fee structure for an M&A deal varies with the scale of the deal. If we're talking about a technology transaction that's under $50 million in enterprise value, then a 4% fee is actually pretty standard, pretty common. You will have firms that are pitching lower fee structures, but typically one of two things is going on. Either they have a big minimum that drives the actual fee up higher, or they're not really a specialist, but they're trying to get an entry into a new market by winning a mandate, so they'll be learning on your dime. Once you're over 50 million, you see fee scales go down, 3%, 50 to 100, 2% over 100, 1% as they get bigger than that. And then on the capital raise side, we don't do as much in early stage, and I frankly don't see as valuable a role for the advisors there, but for like a Series C $25 million raise, again, you'll see 2 to 4%, and often the advisor taking part of that in equity and part of that in cash. And then finally, if we're talking about an IPO, the total cost is probably going to be about 8% of the capital raised. A lot of that is to the advisors, but there are a lot of other fees that go along with preparing for an IPO. Hopefully that answers the question. That's a bit of a winding road, but if anyone has a specific situation where they would want some feedback on what's an appropriate fee scale, I'm happy to address that via email.
Okay, excellent. Okay, here's another one. Let's say you own a privately held small but profitable tech company without debt or institutional investors. What should you weigh when considering a capital raise to fuel growth versus selling M&A?
That's a great, I love that question, because I mean, that is exactly what owners of these privately held emerging tech companies that are bootstrapped need to be thinking about. So I was talking with Joe Kraus at Google Ventures. He had architects back in the day, so he had an early search engine company, very seasoned executive, been around, seen a lot, and he's now making investments for Google Ventures. His bias was, if a company has been operating bootstrapped and hasn't been growing quickly, they're not a great target for growth capital, because they don't have the discipline and the urgency and the risk tolerance to go and spend a bunch of money up front to drive growth later. And that's a bias from investors that you're gonna, so it doesn't mean you can't raise capital. It means you're gonna have to overcome it in order to achieve a capital raise at a valuation that you're happy with. So in many cases, it makes more sense to pursue the M&A path because it's a liquidity event, and you don't have those question marks around, can management actually pivot to a different kind of operating model that's appropriate for a venture-backed company? And here again, I'm happy to discuss this directly or via email if that's worth further consideration. Tara, we're over the hour. I think we'll have a chance to address the additional questions via email. And finally, I encourage you to go and visit the SecureDocs site, where there will be not only the presentation we've gone through today, but also the cheat sheet I mentioned earlier, which is your back pocket guide to how to select an M&A advisor.
Okay, excellent. Well, thank you, Nat, and thank you everyone for attending today's webinar.